Yes, question.
Can you go over again the Fed reverse repo transactions? I'm not sure that I understand the solutions from the midterm problem.
The Fed reverse. Oh, I was talking about how it's going to get out of the midterm problem. Which midterm problem was that?
2009.
Which asked what?
How the Fed might do reverse repo using its holdings of Treasury securities?
Yes.
To get out of
Using T-bills. Okay. Okay.
One of the study questions was, Minsky views the lender of last resort function as central to monetary policy. How does the lender of last resort work use balance sheets? And so the example, like we went over in our discussion, was basically just providing credit through deposits. But I guess there was another way of doing it via T-bills. And that's why I was confused.
Okay, so it's not about this. It's about lender of last resort. So that we can connect there too. These are the same questions, sort of, but expansion versus contraction. Yeah. The central bank is a key player because they're at the top of the hierarchy, and so what they do on their balance sheet has consequences for everyone else farther down. Okay, so it's not that this course is a course in central banking or monetary policy or something. We focus on the central bank because they're a central player. They're the banker's bank and the government bank. They're the place where all of this settlement stuff all comes together. Now, the balance sheet of the Fed is what we're talking about there. Okay, and so there was a question about the about lender of last resort. Lender of last resort. So we could have a bank here, and one way the Fed can make if this bank has reserves here, these reserves are a liability of the Fed. If the bank has insufficient reserves or needs more, okay, it can get them from the Fed, okay, through the discount window. So that's one place to start, okay, and that would be so plus reserves plus discount loan plus reserves plus discount loan. Okay. That is a way in which the Fed can be a lender of last resort to an individual bank, to probably a deficit bank that's having problems settling, okay, because that would be, really targeted directly at that bank. Alternatively, the Fed can intervene in the market as a whole, okay, just through expansionary open market operations, okay. It could, so this is the targeted version. Okay. It could also, remember, in fact, I talked about this when we were talking about the crisis. In a mild crisis, you can lower the Fed funds rate, try to take some of the imbalance of the system on your own balance sheet. The way that works is that you might you might just go into the open market and do repo to expand reserves like this. Okay, so this is a market-oriented thing, okay, where repo you're doing a trade with a dealer, okay, and that shows up as extra reserves on a balance sheet of a bank that works for that dealer, okay. I've shown you this 2 or 3 times, actually, so that there will be a bank, ultimately, that has those reserves, but the counterpart on that side is not a discount loan, but a deposit account of a dealer or something like that, okay. I think maybe that's what the Minsky, I didn't actually see that handout, so I think that's probably what they were about. Now, where do T-bills come in here? The T-bills are security for this repo, okay, so they're the collateral for this repo. If it were permanent open market operations, okay, you could just buy a T-bill by expanding reserves outright. So this is permanent market intervention. In practice, before the crisis, the Fed was mostly intervening daily in repo, temporary, but then every now and then it had intervened enough that it kept rolling over this repo and it said, you know what, this is now permanent. So it just didn't roll over the repo and it just bought a T-bill instead. So it made it permanent. It became part of the, this is really how the Fed operated. So it would, and that would be, then that would add it to the system open market account as a security. So these are three, you see, these are three different transactions from the point of view of what kind of an asset is the Fed acquiring, but all three of them are expansion of reserves in the system and on the balance sheet of some bank. So that's, I don't actually know what that handout was, but I assume that's sort of the direction it was taking. Yeah.
So when they're intervening in the term market, they're buying like just longer term bonds, or like when we said, like for example, the crisis you mentioned.
The medium level crisis. When you're intervening in the medium level crisis, instead of lending overnight or 3 days, okay, you're lending for 30 days or for 3 months or something like that. Okay.
Still doing repo, or are they buying?
Well, you can do repo to any term you want, but you could also make direct loans. Like a discount loan you can make a direct advance as well against some kind of security. A repo is a specific, legal construction, okay? Whereas normal loans, you can have collateral for those normal loans. Discount loans have collateral of various kinds, but it's not structured as the purchase and sale of that collateral, okay? It's just there to secure the loan. This is all sort of, short-term stuff, but if you were moving into the term market, you're talking about longer term stuff here. And if you're moving into the bond market, you're buying bonds, okay? You're buying mortgage-backed securities here. So, but in all cases, you're funding them by something shorter term. Now, so the question about reverses is just about, suppose that the Fed is worried, which it is, okay, that it has way too many reserves here and this is high-powered money, and it would like to basically lengthen the term of its liability side. Okay, lengthen the term of its liability side. And having reserves that are high-powered money, this is basically on demand deposits. These are basically demand deposits in the Fed. Okay, and one way to do that would be to go into the reverse business. Okay, which is to say that I'm going to offer my treasury bills as security. I'm going to borrow for 30 days. Okay, I'm going to borrow from you for 30 days. And in doing so, you lend me money, and lending money is reserves. You give reserves back to me, and so I'm replacing. Let me just put it above here so I can't. So suppose it's like this. Okay, we're trying to get rid of reserves here, and the way we do it is by using this treasury bill as security for borrowing longer term in the market. Okay, so we borrow plus reverse here for 30 days, say, using the treasury as security for that. When the dealers, this is a repo, right? So it's a paired purchase sale of a bill. So essentially, I'm selling this treasury bill. And then I'm offering to buy it back. I'm basically replacing this overnight reserves with this 30-day reserves. Okay, you could say that the T-bill is leaving the balance sheet, but it's just collateral. It's coming back. So I'm leaving it. The balance sheet itself isn't shrinking, okay, in the way I'm setting it up. You're just replacing this overnight reserves with a 30-day position instead. Because when the dealer pays me for this, okay, I get reserves as an asset, and that cancels against that. Okay, so this is the way. This is one strategy for the Fed reducing the maturity of its balance sheet. extending the maturity of the liabilities on its balance sheet. It doesn't want to have these high-powered reserves. It could do it with 30 days. It could also do it, we talked about offering these 30-day deposit accounts, or there's other methods, again, that are similar. Just as there's sort of 3 ways here, there are going to be a bunch of ways that you could change the maturity on this side as well. But it's all messing with the maturity on this side is the point of that, to reduce the quantity of reserves. If you wanted to really reduce the size of your balance sheet, you've got to get rid of both of these things. You know, you can't just be changing the maturity, okay? You have to be shrinking your balance sheet. And the Fed is not doing that, obviously, with QE3 at all. It's expanding the size of its balance sheet, $40 billion a month.